Everyone thinks this crisis happened because greedy bankers gave out bad mortgages, but the real cause is way darker. Yes, banks made reckless loans. Yes, homeowners borrowed money they couldn't afford. But the 2008 financial crisis wasn't just about bad mortgages. It was about a financial system so complex, so leveraged, and so addicted to risk that when one piece cracked, the entire global economy nearly collapsed. And the scariest part? Most people didn't even know they were inside the bubble. Picture this. It's September 2008. On Wall Street, traders stare at their screens in disbelief. Stock prices are plunging. Phones won't stop ringing. Liquidity is evaporating. Outside, ordinary Americans are lining up at banks. Retirement accounts are being wiped out. Homeowners are receiving foreclosure notices. In London, Tokyo, Frankfurt, markets are crashing in sync. People were panicking. Banks were melting. And economists were pretending they had a plan. The crisis didn't stay on Wall Street. It moved to Main Street. Construction workers lost jobs. Small businesses closed. College graduates entered the worst job market in decades. But to understand how this happened, we need to go back to the beginning. They blamed subprime mortgages. The official explanation was simple. Banks gave home loans to risky borrowers. Housing prices fell. Borrowers defaulted. Banks lost money. Case closed. But that wasn't the truth. Subprime mortgages were just the spark. The real fire was built inside the financial system itself. Because home loans weren't staying with the banks that issued them. They were being packaged, sliced, and sold across the globe. Mortgage-backed securities, collateralized debt obligations, complex derivatives that most investors barely understood. Wall Street had turned mortgages into tradable assets, and investors loved them. Why? Because they appeared safe. Credit rating agencies labeled many of these securities as A, the highest safety rating possible. Pension funds bought them. Insurance companies bought them. Foreign banks bought them. Everyone believed housing prices would keep rising forever. Except that wasn't reality. Because the hidden reason is much worse. Behind the scenes, the entire system was built on leverage. Massive, dangerous leverage. Investment banks like Lehman Brothers and Stearns were borrowing up to $30 or even $40 for every $1 they actually had. That means if their assets fell just 3% in value, they were technically insolvent. But it didn't stop there. Banks weren't just selling mortgage securities. They were betting on them. Through instruments called credit default swaps, firms like AG were insuring billions of dollars worth of mortgage bonds. They collected fees, assuming defaults would remain low. But they didn't keep enough capital to pay out if the system failed. It was like selling fire insurance across an entire city, without having the money to cover a wildfire. And regulators? They trusted the system. They believed markets were self-correcting. They believed financial innovation reduced risk. In reality, it concentrated risk in places nobody was watching. Housing prices began falling in 2006. Defaults started rising in 2007. By 2008, the losses were spreading through the global financial bloodstream. And that's not even the craziest part. Because when confidence disappeared, everything froze. Banks stopped trusting each other. And in modern finance, banks lend to each other every single day to stay liquid. When fear entered the system, interbank lending collapsed. Credit markets froze. Even healthy businesses couldn't access short-term loans to pay employees or buy inventory. This created a chain reaction that nobody could stop. In March 2008, Stearns collapsed and was sold in an emergency deal. Then came September. Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in U.S. history. Markets panicked. Money market funds, once considered ultra-safe, broke the buck. The Dow Jones fell hundreds of points in hours. And suddenly, the crisis was no longer theoretical. It was global. European banks that had bought U.S. mortgage securities were facing collapse. Asian markets plunged. Global trade slowed dramatically. Meanwhile, millions of Americans were losing their homes. Foreclosures surged. Entire neighborhoods were filled with empty houses. Unemployment rose from 5% to 10% in less than 2 years. Retirement accounts were cut in half. Small businesses couldn't survive the credit drought. This wasn't just a housing problem anymore. This was systemic failure. This was the moment the entire system cracked. By October 2008, the U.S. financial system was on the edge of total collapse. If major banks failed in sequence, ATMs could stop working. Payroll systems could freeze. Global trade could halt. Policymakers faced an unthinkable choice: let the system collapse, or rescue the very institutions that caused the disaster. The U.S. government launched TARP, the Troubled Asset Relief Program, injecting hundreds of billions of dollars into banks. The Federal Reserve slashed interest rates to near zero. It began unprecedented emergency lending. Quantitative easing was introduced, creating money electronically to stabilize markets. Similar measures were taken by central banks worldwide. Governments stepped in because they had learned from history. Because in the 1930s, hesitation turned recession into depression. This time, they acted fast, but the cost was enormous. Public trust collapsed, debt levels exploded, and inequality widened. But here's the part that still affects you right now. The 2008 crisis permanently changed the financial world. Banks now face stricter capital requirements. Stress tests became routine. Regulations like the Dodd-Frank Act reshaped Wall Street. But the deeper impact goes beyond regulation. Interest rates stayed near zero for years after the crisis. This reshaped everything. Housing prices surged again. Stock markets entered a historic bull run. Investors began chasing risk in search of yield. Cheap money became normal. Central banks proved they would step in during emergencies. This created a new expectation, the central bank safety net. Markets started assuming that if things go wrong, intervention will come, and that belief changes behavior. The crisis also accelerated political division. Millions lost homes while major banks were rescued. That anger reshaped elections, policy debates, and public trust in institutions. Even today, when inflation rises or markets fall, echoes of 2008 guide central bank decisions. The way your mortgage rate is set. The reason banks hold more capital. The reason governments move aggressively during crises. It all traces back to 2008. And here's the uncomfortable truth. The system didn't become less complex. It became bigger. Global debt today is far higher than it was before the crisis. Financial markets are even more interconnected, which means confidence still matters more than fundamentals. So what really caused the 2008 financial crisis? Not just subprime mortgages. It was leverage. It was blind faith in rising asset prices. It was complex financial engineering nobody fully understood. It was regulators who trusted models more than reality. It was institutions that believed they were too big to fail. But above all, it was human behavior. Greed during the boom, denial during the bubble, panic during the collapse. Finance isn't logical. It's emotional chaos with a price tag. And when that chaos spreads from Wall Street to Main Street, everyone pays.